Good afternoon and welcome to Bulls, Bears, and the Bell, your express ticket to, well, getting truly clued up on the ever-shifting world of finance. Today we're embarking on a deep dive into a really captivating day in the global financial markets, September 4th, 2025. It was one of those days, where that classic, almost counterintuitive paradox played out big time, the idea that bad news is in fact good news. We saw what looked like, well, unambiguously negative economic data suddenly spark this huge wave of optimism, sent ripples right across trading floors worldwide.
That's exactly right. The fundamental mechanism driving things today was precisely that paradox, an unexpected and actually quite significant slowdown in the crucial U.S. jobs market that ignited these really fervent hopes that the Federal Reserve would finally have the justification, undeniable proof it needed to start cutting interest rates. For the market, this wasn't just a minor tweak. It was like seeing a flashing green light for cheaper money. And that's just a powerful, almost irresistible force, isn't it? Propelled global equities upwards, set a really positive tone.
Okay, let's unpack this fascinating dynamic then. Our mission for this deep dive is to really understand the anatomy of this market reaction. We'll start by dissecting that primary U.S. catalyst, peeling back the layers of the job report, make sense of that first. Then we'll navigate the nuanced, often, well, contradictory performance of UK markets, global optimism versus domestic strain, right?
Exactly. A real push and pull there.
From there, we'll dive into the specific individual stories behind some of the day's biggest company surges and falls, understand the mechanics, the why. And finally, we'll zoom back out. Consider what this all means for the crucial days immediately ahead. Our goal, as always, is to arm you, the listener, with a quick yet thorough and insightful understanding, hopefully sparking those aha moments that make finance not just comprehensible, but genuinely intriguing. Right, let's kick things off by zeroing in on the undeniable primary driver of market movements on September 4th, 2025. The U.S. private sector jobs market. The headline news, or maybe we should say the bad news that turned out to be so good, was this unexpected, quite pronounced slowdown in hiring. And this wasn't just a blip, was it? It felt like a significant shift, enough to set the tone globally.
Oh, absolutely. And it wasn't a minor miss. The market's attention was laser-focused on the U.S. ADP National Employment Report. Now, for anyone not familiar, the ADP report is often seen as a crucial precursor, sort of a sneak peek, before the official government jobs data comes out later. And the numbers today were, well, frankly, quite stark. The U.S. private sector added a mere 54,000 jobs in August. Just 54,000.
Wow, 54,000. That sounds really low. What were people expecting?
Well, exactly. To put that in perspective, it was dramatically lower than what economists had broadly expected. They were looking for something closer to 100,000 jobs. And maybe even more critically, it was barely half of the 106,000 jobs created just the month before in July. So that signifies a considerable loss of momentum, a real cooling in hiring. Dr. Neela Richardson, she's the chief economist at ADP, she put it down to a mix of things. Persistent labor shortages, which are still a factor apparently, increasing consumer apprehension, people may be getting a bit worried, and interestingly, even disruptions related to artificial intelligence playing a role in some sectors.
AI impacting jobs already. That's significant.
It seems to be starting to filter through, yes. It's a complex picture, but the net effect, that slowdown, was undeniable. And reinforcing this narrative of a softening job market, we also got the weekly unemployment claims data. That came out alongside the ADP report. The number of Americans filing new claims for unemployment benefits rose by 8,000. That brought the total to 237,000 in the last week of August.
And was that higher than expected, too?
Yes, it was. Also higher than the consensus forecast, which anticipated a smaller increase, maybe to around 230,000. So you put these two pieces together, the slow pace of new hiring, the uptick in claims, it just adds more compelling evidence. Evidence that the tightness in the labor market, which the Fed has been trying so hard to cool down to fight inflation, is finally starting to ease, and that easing is exactly what the market was, well, desperately hoping to see.
Okay, so the overall picture was weaker hiring, more people claiming benefits. But was it weak everywhere? Or were there variations?
Good question. If we dig into the ADP figures a bit more, you see a more nuanced picture. It wasn't a uniform slowdown at all. Quite selective, actually. Some areas, particularly in the goods-producing segments, they actually saw job losses. Manufacturing, for instance, often a bellwether, right? It shed 7,000 jobs. And the trade, transportation, and utility sector, think of logistics, supply chains that lost 17,000 positions. So that suggests maybe a softening in demand for physical goods and the infrastructure needed to move them around.
Okay, so goods and logistics slowing down. But what about services?
That's where the contrast lies. It wasn't all negative. Leisure and hospitality, Restaurants, hotels, travel that remained a key source of growth. It added a pretty robust 50,000 jobs.
Still spending there then.
Seems so. Despite some apprehension, people are still going out, dining, traveling. It shows some resilience in consumer spending, at least in certain areas. Construction also held up surprisingly well, adding 16,000 jobs, maybe linked to ongoing infrastructure projects or perhaps specific housing market dynamics. So this divergence, it tells a crucial story. Consumer-facing services, still hiring, maybe showing a shift in spending patterns. But goods-producing and logistics industries, they're clearly feeling the pressure. Maybe reduced corporate demand, maybe supply chains adjusting, maybe those higher interest rates finally biting. It's definitely not a simple monolithic picture of economic health.
Okay, here's where it gets really interesting, isn't it? The market's logic twisting around. This is that bad news is good news paradigm in full effect. It can seem totally counterintuitive if you're not deep in the markets day to day. So I want you, our listener, to think about this. Why would data suggesting a weakening jobs market something that sounds bad for the economy, bad for people's jobs? Why would investors greet that with such enthusiasm? What's the logic?
It is logical, but you have to understand the current market mindset, the overriding obsession with central banks. For investors right now, a cooling labor market isn't primarily seen as a sign of immediate economic disaster. Not in this context, anyway. Rather, it's interpreted as a powerful, almost unambiguous sign that wage-driven inflationary pressures are finally receding. And that's the key. That gives the Federal Reserve the justification it needs, the green light, essentially, to pivot, to move towards a more accommodative monetary policy. In simple terms, start lowering interest rates.
Right. The Fed gets its excuse to cut.
Exactly. Think of it like a patient with a fever. A slight drop in temperature is seen as a sign the medicine's working, maybe the doctor can reduce the dose, and the expectation of imminent, maybe even sustained rate cuts is profoundly bullish for equity markets.
Why exactly? Just
Yeah.
spell that out.
Well, two main reasons. First, lower borrowing costs make it cheaper for companies to expand, invest, operate. That could mean higher profits down the line. Second, it makes stocks look much more attractive compared to fixed income investments, like bonds. When interest rates are high, bonds offer a good, safe return. But as rates fall, the appeal of those fixed returns drops. So capital tends to flow out of bonds and into equities, chasing higher potential growth and yield. Kathy Jones, she's the chief fixed income strategist at Schwab, she basically said this ADP report should solidify expectations for a Fed rate cut later in September. It was the confirmation the market was looking for.
And the reaction in the U.S. markets reflected that confirmation.
Oh, immediately and dramatically. It was decisively positive. This wave of optimism just propelled Wall Street to new heights. Shows you how powerful the prospect of cheaper money is. The S&P 500, the broad measure, surged about 0.8%, closed at a new record high, 6,502.08 points. The Dow Jones, the big industrials, climbed a similar 0.8%, hitting 45,621.29. And the NASDAQ, the tech index, did even better, gained a full 1.0% to finish at 21,707.69. So this robust performance in the world's biggest equity market wasn't just a U.S. story. It put a rocket under global sentiment, set a really positive tone everywhere. It's a stark reminder, isn't it? The market's primary focus right now is less on the economy's immediate pulse and much more, often overwhelmingly so, on the Fed's next move. That's the real driver.
So this U.S. optimism, it spread overseas. How did London react, for instance?
Yes, the enthusiasm definitely wasn't confined to the U.S. The prospect of a more dovish Fed, plus Wall Street's strong showing, sent positive ripples everywhere. In London, for example, stocks opened higher and kept those gains through the day, directly tracking that Wall Street sentiment. And there's an interesting side effect, too. The U.S. dollar tends to weaken when lower U.S. rates are expected. And that actually helps many FTSE 100 companies, the big multinationals, A lot of them earn revenue in foreign currencies. When those earnings are converted back into a weaker dollar, they suddenly look bigger on paper. It's a nice translational boost. So yeah, the interconnectedness means U.S. labor data had a surprisingly direct, positive impact on London's big global firms.
Okay. What's fascinating here is that market psychology, isn't it? This hierarchy of concerns.
It really is. It reveals a clear and, you could say, somewhat unsettling hierarchy. The potential for lower interest rates, for more liquidity from the Fed that is, right now, a far more potent driver of investor behavior than the underlying health of the U.S. economy itself. Think about it. A rally to record highs, built directly on the back of weakening employment data. It illustrates a market psychology that's become heavily, maybe even overly, dependent on the flow of central bank capital, almost addicted to the prospect of cheaper money.
Which sounds potentially fragile.
It could be. It creates a potentially fragile equilibrium. Many investors are celebrating this data, calling it a soft landing. The economy cools enough to tame inflation without crashing into recession. But it could also be an early warning, a sign of a more significant downturn still unfolding that the market is just trying to ignore by betting on the Fed. And this raises a critical question, maybe a provocative one. What if inflation proves stickier than expected, even as growth slows? A stagflation scenario. Then the Fed might be in a really tough spot, unable to cut rates as much or as fast as the market now expects because inflation's still too high. That sets up a potential collision course down the line, doesn't it? Between market hopes and economic reality. A big risk. It's a delicate balance, walking a knife's edge between optimism about policy and underlying economic worries. Every piece of data gets filtered through that Fed lens.
A crucial point about that knife's edge. Now, let's pivot. Let's see how this surge of global optimism, mostly imported from the US, played out here in the UK markets. London certainly joined the rally, but it felt like it was doing so against a much more complex, increasingly challenging domestic backdrop. It felt like the global tailwinds were lifting the big boats, but couldn't quite hide the local strain, those domestic pressures bubbling away here.
Yeah, you've absolutely hit the nail on the head there. That's the core tension. While global tailwinds definitely lifted our main indices, beneath the surface, the UK's domestic economy is grappling with a really complicated, often contradictory set of signals. So the blue-chip FTSE 100, heavily weighted with those multinationals earning overseas, it closed up about more than 0.4%, finishing at 9,216.87. That largely reflected the positive Wall Street sentiment and that weaker dollar helping its global earners. Pretty straightforward.
Okay, FTSE 100 up. What about the more UK-focused index, the FTSE 250?
Right, the FTSE 250, which is full of medium-sized UK companies, actually saw an even stronger performance. It climbed about 0.8% to end the day at 21,474.68. Now, that suggests a healthy appetite for UK-centric mid-cap stocks on a risk-on day like today. Maybe investors betting these companies can capitalize more directly on any perceived improvements or just benefiting from a broad shift to growth assets. But, and this is a critical detail, this rally didn't extend everywhere.
Okay. Where did it stall?
The AIM All-Share Index, that's the barometer for smaller, often less established growth companies. It actually finished the day down around 0.8%.
Down 0.8% on a day like this. That's quite a divergence.
It is a significant divergence, and it tells us something crucial. While the global tide lifts some boats, the health of the underlying domestic economy is still a major worry for investors looking at smaller, potentially more vulnerable businesses. There's split in confidence there.
That's quite the head-scratcher, isn't it? FTSE 250 outperforming the 100, but AIM falling back. What explains that very performance within the UK market itself, especially on a globally optimistic day?
It's a great question, and it really highlights the nuances, doesn't it? How investors differentiate. The FTSE 100's gains, though solid, were probably held back a bit by some of its heavyweight components. Think commodities, airlines. Those sectors face their own specific global challenges, volatile raw material prices for miners, intense competition, and fuel costs for airlines. So even with positive sentiment, those specific headwinds acted as a bit of a drag on the main index.
Okay, so sector drags on the FTSE. Why the strength in the 250 then?
The stronger rise in the FTSE 250 suggests that when there's a risk-on mood, investors sometimes look for growth potential within the domestic market itself. They might be bidding these mid-caps, while more exposed to the UK economy, are also more agile. Maybe better placed to leverage improving sentiment even if that sentiment is imported. Perhaps the feeling is they're less priced for perfection than the huge global giants. More room to grow.
And the AIM decline, just pure domestic caution.
Pretty much. The fall in the AIM All-Share is a critical indicator of that underlying caution. It suggests investors remain really wary about smaller, less established firms. These companies are typically much more exposed to the nitty-gritty health of the UK domestic economy. They often have less diversification, less robust balance sheets to weather storms. So while global sentiment pushes large and mid-caps up, those deep-seated concerns about the UK's own economic health are still weighing heavily on these smaller, more vulnerable players. It shows a very clear split in confidence, a flight to perceived quality to resilience, even within the UK market. It's like the market saying, yeah, the global picture looks okay, but we're still pretty worried about what's happening right here on our doorstep.
That makes perfect sense, reinforces how crucial a strong balance sheet is in times like these. So let's look beyond the market reaction. What does this all mean for the UK economy itself? What are those underlying challenges, those contradictory signals we need to be aware of?
Right, the UK economic backdrop is, well, it's genuinely complicated. A real mix of contradictory signals that make forecasting tough. On what seems like a positive note, the British Chambers of Commerce, the BCC, They actually upgraded their GDP growth forecast for 2025, up to 1.3% from 1.1%. They put that down mainly to a stronger than expected performance in the first quarter of the year, helped by public spending. So on the surface, encouraging, some resilience.
So you said contradictory signal.
Exactly, because that bit of good news was almost immediately counterbalanced by some persistent, pretty concerning headwinds. The very same BCC report flagged that inflation remains a thorn in the side of the UK economy. It just won't go away easily. Their forecast for CPI, the Consumer Price Index, at the end of 2025 was actually revised upwards to a stubborn 3.7%.
3.7%. Still quite high. What does that mean for Bank of England rates?
Well, it makes it highly unlikely the Bank of England can follow the Fed's potential lead and cut rates anytime soon. In fact, the base rate is expected to stay at a restrictive 4% by the end of the year. So while the U.S. market is cheering potential cuts, the U.K. faces a much tighter, more painful monetary policy outlook. A stark divergence.
Ouch. Okay, so sticky inflation, no rate cuts likely. What else?
This is a big one. Business investment. The BCC dramatically downgraded its forecast for business investment growth in 2025. They previously expected a healthy 4.8% expansion. That's been slashed to just 1.6%.
Whoa. Slashed from 4.8% to 1.6%. Why is such a big drop?
They squarely blamed rising costs for businesses and pointed specifically to the increase in employer national insurance contributions, the NICs. For many firms, especially smaller ones, these higher costs directly hit their ability and their willingness to invest in growth, new equipment, tech, expansion. It's a direct hit to future productivity.
And that pressure on businesses, is it showing up in jobs too?
Unfortunately, yes. Adding to this gloomy picture, a monthly survey from the Bank of England itself they survey, CFOs found that UK businesses cut jobs at the fastest pace in 4 years in the 3 months up to August. That's not just a statistic, it's real people losing jobs. And nearly half of the 2,130 companies surveyed directly blamed those increased employer NICs as a significant reason for cutting staff. It's an alarming signal. Economic pressure translating into job losses, which hits consumer confidence. A worrying trend.
Any specific sectors looking particularly weak?
Yes, construction. A specific snapshot that paints a clear picture of strain. The latest PMI survey, the Purchasing Managers Index, showed construction activity fell for the 8th consecutive month. That's the longest continuous downturn for the sector since the depths of the COVID pandemic. Both new work and employment levels were down solidly. That has real knock-on effects: jobs, supply chains, future building projects. So yes, some pockets of growth maybe, but some very strong, deeply embedded headwinds hitting core parts of the economy. Makes the UK's overall resilience look quite fragile.
Wow, that's a sobering domestic picture. Was there any good news on the financial front here in the UK?
Well, yes, despite those challenges, one notable source of relief, at least for the broader market, was the stabilization we saw in UK government bond yields, or gilt yields. Remember, they'd had a really turbulent time recently. The 30-year gilt yield briefly touched its highest level since 1998, caused a lot of anxiety. But today, a welcome sense of calm returned. The 30-year yield dipped back to 5.56%, down from that high of 5.75% the day before.
And why is that easing of gilt yields so important for stocks?
It's quite significant. It creates a more supportive backdrop for equities. It reduces the relative attractiveness of bonds as a competing investment. When bond yields are screaming higher, they offer a safe high return, pulling money away from riskier stocks. So seeing yields stabilize, seeing less stress in government borrowing costs, it offered some much-needed breathing room for equity markets, helped prevent a potentially deeper sell-off.
Okay, now that we've set the stage with the big picture, global optimism, UK strain, stabilized bonds, let's zoom in. Let's get into some individual company stories where news, or sometimes the lack of it, really move the needle. These are the stories behind the stocks, right? They give us that granular understanding of market mechanics. Let's start with some of the day's biggest gainers on the FTSE 350.
Absolutely. Kicking off the winners list is Kininos Group plc. An IT services firm, it really caught the eye. Shares soared a remarkable 22.49% to close at 866p. Just a
22%. What caused that?
News today. Not today, actually. It was a powerful, sustained reaction to a really positive trading statement they issued back on September 1st. The company announced it now expects revenues for the fiscal year ending March 2026 to be at the upper end of consensus forecasts. Very strong guidance, and they back that up with specifics. Stronger than expected sales overall, winning significant new public sector deals, Home Office, NHS England mentioned, plus a big milestone for their Workday Products division, which topped $100 million in annual recurring revenue back in July. The scale of this multi-day rally tells you the update was a genuine material surprise. Forced analysts, investors, everyone to rethink Kainos' growth trajectory. A real standout.
Okay, a strong update driving Kainos. Who else was climbing?
Next up, Domino's Pizza Group plc. Shares climbed a healthy 8.76% to 212.40p, continuing a recovery we saw start earlier this week. The main catalyst here was an announcement again on September 1st of a new 20 million share buyback program.
Ah, buyback. Always popular with investors.
Very much so. Management explicitly said the move was to capitalize on a big share price plunge they suffered in August after cutting their full-year profit guidance. So this buyback, it sends a powerful signal, doesn't it? Management confidence in the underlying business, despite the recent wobble, a belief the stock's undervalued. And mechanically, buying back shares reduces the share count, boosts earnings per share, communicates they see better returns in their own stock than elsewhere. Clearly resonated with investors looking for value.
Makes sense. Who is next on the gainers list?
Then we have Hochschild Mining plc, the precious metals miner. Shares rose a solid 6.76% to 300p. Here, the market was still digesting and clearly approving of strategic news from September 3rd. They announced a plan to divest their non-core Vulcan gold project in Chile.
Divesting? How are they doing that?
It's structured as a reverse takeover with a company called Railtown Capital. It'll create a new, separately listed entity on the TSX Venture Exchange in Canada. Crucially, Hochschild keeps a big stake, around 87%, in this new company. The market likes this because it's seen as a smart value-unlocking move. It lets Hochschild focus resources on its core assets in Peru, Brazil, Argentina, while de-risking the Vulcan project off its own balance sheet, but still keeping exposure to its potential upside. Smart structuring.
Okay, strategic clarity paying off for Hochschild. Anyone else notable?
Metrobank Holdings plc saw a decent gain too, up 3.90% to 122.60p. Interestingly, no specific news catalyst for Metrobank today. Instead, its performance looks like a continuation of positive momentum built up over the last month or so, amplified by today's broad risk-on mood.
What drove that earlier momentum?
Well, they reported a significant swing back to profitability in their half-year results on August 6th, a key turning point for the challenger bank. That was followed by a notable broker upgrade from RBC Capital Markets to outperform on August 19th. Analyst confidence picking up. So it shows how a stock with an improving fundamental story can just attract sustained buying interest. And it outperforms when the wider market's rising as investors price in that positive shift. Sometimes momentum just builds.
Right, positive story attracting buyers. One more gainer.
Finally, Molten Ventures plc, the venture capital firm, up 3.63% to 307.880p. Their gains were firmly supported by their ongoing share buyback activities. Another example of that dynamic. There was a regulatory news service announcement this morning, September 4th, confirming a transaction in owned shares. Detailed the purchase of 50,000 ordinary shares just yesterday, September 3rd. This consistent, transparent repurchasing provides steady demand for the stock, reinforces commitment to shareholder value through active capital management, signals competence, a tangible return of capital.
So those were the winners. Strong updates, buybacks, strategic moves, improving fundamentals. Now let's flip the coin. The top FTSE 350 losers, where different forces were clearly at play. First up, SSE plc, the big energy company. Surprisingly, the top faller in the FTSE 350 today declined 3.09% to 1,676.50p. What's really anomalous here and caught my eye is that peers like United Utilities were gaining. The utility sector was generally strong. What could cause such a divergence for a major player like SSE?
That's a really keen observation and makes SSE's fall particularly puzzling at first glance, exactly because it bucked its sector trend. There was absolutely no specific negative news about SSE today. In fact, as you said, reports earlier showed bond proxy utility stocks were doing well. United Utilities up 1.5%, National Grid up 1.3%. So SSE's significant underperformance suggests some kind of stock-specific selling pressure,
Maybe.
something not obvious in the headlines.
What could be behind it?
Well, a few possibilities, each illustrating different market mechanics. It could be a large institutional shareholder selling down a big chunk of their holding, maybe rebalancing, maybe a strategy shift we don't know about, or it could be whispers of a negative research note from a big broker, maybe shared with key clients before it becomes public, influencing selling. Or perhaps simply significant profit-taking after a good run. Some investors might have seen it as having run ahead, decided to lock in gains on a strong market day. Without clear news, it's speculation. but it shows individual stocks can move for reasons hidden from the public eye.
Okay, a bit of a mystery for SSE. Next loser.
Next, we saw Burberry Group plc, the luxury fashion house, fell 2.77% to 1,248 at 0 BP. Now, this one is a clear, almost textbook case of fundamentals trampling all over technical factors. The fall came on the very same day it was confirmed Burberry would be promoted back into the FTSE 100 index in the quarterly review. Normally, index inclusion is a positive catalyst, right? Forces tracker funds to buy.
That's the ultimate paradox, isn't it? Confirmed promotion to the FTSE, which usually boosts the stock, yet Burberry fell. How do we explain that? It seems totally counterintuitive.
It does. And it's a classic, potent example of investors selling the news, or rather, ignoring the headline news and focusing on the grim reality underneath. Investors completely look past the technical positive of index inclusion. They focus squarely on Burberry's deeply challenging financial situation. Recent reports showed a worrying 40% slump in profits, contracting revenues, signaling real struggles in the luxury market. Plus, they had a CEO change back in July, often a sign of trouble. And crucially, they suspended their dividend for the 2025 financial year, a big red flag for many investors.
So the market just has no faith in the turnaround.
Effectively, yes. The market's signaling a profound lack of confidence, believing the underlying business struggles and the lack of a clear recovery path far outweighed the prestige or technical buying from index promotion. They're betting the fundamental challenges are just too big right now. Prioritize the grim story over a fleeting technical boost.
Wow. Fundamentals win out there. Who else struggled?
Then we had EasyJet plc. It was actually the biggest loser within the FTSE 100 index itself today. Shares fell 4.21% to 466.30 p. And the interesting, important point here is the sell-off wasn't triggered by any news directly from EasyJet.
So if it wasn't EasyJet's news, how does bad news from a competitor like Jet2 apparently hit EasyJet so hard, drag it down like that?
It's a classic case of what we call negative sentiment contagion. Bad news for one player spreads quickly across the whole sector like ripples in a pond. The sell-off was triggered by a negative trading update from its rival Jet2. Jet2 announced it expected its full-year operating profit to be towards the lower end of its previous guidance. That news immediately sparked widespread concerns across the whole travel and leisure sector, especially low-cost carriers. Investors read Jet2's warning as a bad sign for the industry as a whole, fearing all low-cost airlines are likely facing similar headwinds.
Like what kind of headwinds?
Could be waning consumer demand, maybe the cost of living biting, could be stubbornly high fuel costs eating into margins, or just intense price competition as they all fight for passengers. In a sector like airlines, where they face very similar market conditions, bad news for one often gets extrapolated to its closest peers, even if their situations aren't identical. A cautionary tale of sentiment spread.
Okay, sector contagion hitting EasyJet. Any other notable fallers driven by something specific?
Yes. Finally, we saw declines in copper miner Antofagasta plc, down 2.28% to 2,147.0 p, and the insurer Admiral Group plc, down 2.27% to 3,444.00 p. Now, these look like significant percentage drops, might raise concerns for holders.
But if it wasn't poor company performance or bad news, what purely market-driven factor would cause such big drops in two otherwise solid companies?
These falls were not due to bad news or fundamentals deteriorating at all. It was a predictable, purely technical market event. Both companies were trading ex-dividend today, September 4th.
Ex-dividend, right. Remind us what that means exactly.
Sure. When a stock trades ex-dividend, it means if you buy the stock on or after that date, you won't receive the most recently declared dividend payment. That payment goes to whoever owned the share before the ex-dividend date. So consequently, the stock's price is mechanically adjusted downwards on the ex-dividend date by an amount roughly equal to the dividend being paid out, because that cash value is now leaving the company to go to shareholders.
Got it. So the price drops to reflect the payout.
Exactly. For Antofagasta, the price adjusted down for a dividend of 0.166 per share. For Admiral, it was a regular dividend between $1.11 and $1.15 per share, plus a special dividend. It's quite a chunky adjustment. It's absolutely essential. Investors distinguish these mechanical price adjustments from falls caused by genuine problems. These aren't signs of trouble, just the market accounting for the dividend payout. Like taking cash from an ATM, your balance drops, but the bank's fine.
That distinction is incredibly important. Understanding true market moves versus technical adjustments. Okay, let's pull back now. Connect these individual stories to the broader movements globally and within UK sectors. Get that fuller, integrated picture.
Indeed. Quick snapshot of major global indices shows that widespread impact of the U.S.-driven optimism, though, as we noted, there were regional variations. Local factors still matter. U.S. markets, undoubtedly the leaders. All three major indices, strong gains, new records. Driven by that belief, the Fed's poised to cut rates. S&P 500 up 0.80%, Dow also 0.80%, NASDAQ up a full 1.00%. That sentiment carried over to Asia. Japan's Nikkei 225 jumped a healthy 1.50%. Strong regional participation.
But not everywhere joined the party, right? You mentioned China earlier.
Correct. Chinese markets notably diverged, went the other way. The Shanghai Composite fell 1.33%, Hong Kong's Hang Seng down 1.0%. That underperformance probably reflects those ongoing deep-seated worries about China's own economy, property sector, consumer demand, or other local factors that just outweighed the global rate cut story. A reminder, markets don't all move in lockstep. European markets generally were mixed but did trend higher during their session, mostly taking cues from Wall Street's positive open and that overall risk-on mood.
Okay. Now, if we connect this to the bigger picture within the UK specifically, were there any distinct patterns of sector performance in London that really stood out, telling us more about where investors found comfort or concern?
Absolutely. Within the London market, today's trading revealed some very distinct, very telling sector patterns. Gives more insight into that nuanced UK sentiment. Starting with the strong sectors. Consumer staples. Think Tesco, Unilever. They were highlighted as leading the gains.
Defensive stocks doing well then.
Exactly. Suggests defensive posturing. Investors favoring companies providing essential goods. Services, things people buy even when times are tough. It's almost a hedge against that underlying weakness in the UK domestic economy we discussed. A flight to reliable earnings.
Okay. Staples strong. What else?
Utilities. Like United Utilities, up 1.5%. National Grid, up 1.3%.
Yeah.
At a particularly strong showing. And that's logical when bond yields are falling and rate cuts are hoped for elsewhere. Utilities are often seen as bond proxies.
Because of their dividends.
Precisely. Stable, often regulated earnings, consistent, attractive dividends. When bonds look less appealing due to falling yields, that stable income from utilities becomes much more attractive for income investors. Retail stocks also had a surprisingly strong day overall, largely helped by that positive trading update from Currys we touched on. Suggests some consumer-facing businesses, especially those showing operational improvement, are finding favor.
Right. So staples, utilities, some retail strength. What about the weak spots?
On the flip side, the travel and leisure sector was the day's most notable laggard, by far. The whole sector dragged significantly lower, mainly by that negative sentiment from Jet2's cautious outlook, which hit EasyJet and BA owner IAG hard, as we discussed, shows how quickly bad news can ripple through an interconnected industry. Also, precious metal miners like Fresnillo fell back as gold prices eased slightly.
Why did gold ease? Thought it might rate cut hopes.
Well, gold had risen earlier in the week during that bond market turmoil, acting as a classic safe haven. But as calm returned to the gilt market today, as immediate fears subsided, gold's appeal as a crisis hedge just diminished a bit, led to some profit-taking in the miners. Shows how sensitive they are to shifts in broader market fear and stability.
This entire session, then, with its paradoxical rally, the underlying economic currents, it provides a compelling, maybe slightly unsettling view into the current psyche of the global investor. It's a really complex picture, isn't it?
It truly is. I mean, to sum it up, today's market reaction was a textbook case of its prevailing obsession, central bank policy. The implications for monetary liquidity, that promise of cheaper money, it just far outweighed any concerns about fundamental economic health, at least in the immediate term. That rally we saw lift the FTSE 100 and 250, it wasn't born out of domestic strength here, it was imported wholesale from the U.S., where unambiguously weak labor data was paradoxically celebrated as paving the way for rate cuts. It highlights a market that is, for now, almost entirely driven by the prospects of central bank action, rather than genuine economic vibrancy.
But that masks the UK's own issues.
Completely. For the UK, this global optimism serves to mask significant growing fragility within the domestic economy. The positive headline performance of London's big indices stands in stark contrast to the realities on the ground. Remember the construction downturn, the sharp downgrade in business investment forecasts, that Bank of England survey showing firms shedding jobs at the fastest rate in years, and that divergence between the rising large caps and the falling AIM all-share index. That's the clearest manifestation of this split narrative. Global sentiment, bullish, liquidity-driven, domestic confidence, especially for smaller firms, clearly waning, battling persistent headwinds, still very much in play.
That makes the next few days absolutely critical, doesn't it? Almost a moment of truth for this whole narrative. This raises an important question then. What is the single most critical near-term catalyst? What should investors and all of us be watching for to see where this delicate market balance heads next?
Without a doubt, the single most critical near-term catalyst will be the official U.S. non-farm payrolls report, scheduled for release on Friday. This is the definitive jobs report, and it's now become the make-or-break event. It will either emphatically confirm or severely challenge the market's current narrative.
Okay, so what are the scenarios depending on that NFP number?
Right, scenario 1. NFP confirms the weakness we saw in the ADP data. So, significantly weak job creation, maybe below forecasts. That would likely cement expectations for a Fed rate cut in September, could fuel the current rally even further, push markets higher as investors aggressively price in that dovish policy shift. Validation.
Okay, weak data potentially means more gains. What's scenario 2? The opposite.
It's exactly. Scenario 2. NFP delivers a surprise to the upside. Strong job creation, significantly above expectations. That could trigger a rapid, potentially severe market reversal. It would directly challenge this newly formed narrative, force investors to quickly unwind those rate cut bets. That unwinding could lead to a sharp repricing across the board. Bond yields jump, equities tumble as the prospect of cheap money suddenly vanishes.
And is there a middle ground? What if it's just... Okay.
Yes, there's a third, maybe less dramatic, but still impactful scenario. NFP comes in pretty much exactly in line with expectations. Not too hot, not too cold. In that case, the market might just pause for breath. It wouldn't necessarily cause a reversal, but it wouldn't provide that strong catalyst for more aggressive rate cut pricing either. Could lead to a period of consolidation, maybe. Investors looking for the next data point. But the key takeaway is the market is truly balanced on a knife's edge right now. The rally's foundation is built almost entirely on expecting economic weakness to force the Fed's hand. Any real strength in Friday's official jobs report could pull that rug out very quickly. So investors should definitely brace for heightened volatility, be prepared for swift reactions to that data.
What a day of trading, and what a tightrope the markets are currently walking. That paradoxical idea, bad news is good news, truly defined the session. But as we've explored, it's a delicate balance built on very specific expectations that could be challenged as early as tomorrow with that NFP report. Thank you for joining us on this deep dive into the September 4, 2025 market roundup. We really hope you feel much better informed now.
And maybe as you navigate the news in the coming days, just remember this intricate dance between market expectation and economic reality. Ask yourself, how much are these markets truly driven by fundamental economic health, and how much by that enticing promise of cheaper money from central banks? And what really happens when those two narratives inevitably collide? Encourage yourself to think critically, look beyond the immediate headlines, and try to understand the deeper forces at play.
Absolutely. Keep those questions in mind. They're definitely the key to understanding the deeper currents right now. We hope this deep dive has helped you connect the dots and better understand the complex, fascinating forces shaping our financial world. Until next time, keep exploring, keep learning.